like you should ask for help from the people that have invested and are aligned with you, hopefully if they're good people to help you. But the numbers also should just be reported easily. Like
You
I
can't do it
think
by
that
yourself. I think the takeaway there is you can't do it by yourself. Don't try to do it by yourself. Even if you're 2 or 3 founders with a small team under you in your seed stage, like just ask for help. Just be like, hey, we're really struggling with this channel. Do you guys have any ideas for other channels we should try? Like just being open and vulnerable can just lead to lots of good things because you probably have 30, 40, 50 investors on your cap table by the time you hit the A round. So just leverage that network and get help.
All the GPs are out there saying they have a great network. Ask them to put the proof on, proof out
it's in
there,
our name, right?
So,
Team Ignite, right?
right?
Hey, everyone. Welcome back to the Ignite podcast. Today, we're thrilled to have Dave Perretz on the program. He's a standout operator and finance leader in the venture capital ecosystem, from jumping out of planes as an Army officer, pretty cool. My father-in-law did that. We should talk about that. To building institutional grade back offices for emerging venture funds. That's us. We should talk about that too. Dave's career path is anything but typical. He's the founder of Signal Fund Services, where he helps GPs scale with confidence, has also held key finance roles at multiple venture capital firms, including Iron Spring Ventures, Cambrian, I know those guys, and was part of the early team at 2U Laundry. He brings a rare blend of discipline, operational depth, and sharp financial thinking to venture infrastructure. We're excited to have him on the program. Thanks for coming on.
Appreciate it. Thank you for having me.
So what a journey. I mean, from Army to asset management. Tell us about that story arc and what lessons carried over to what you're doing now.
I would love to say that it was a thoroughly planned out journey along the from day one, but it certainly wasn't. I think I was a high school senior on 9/11. It impacted me deeply, and went to summer orientation at school and saw the ROTC booth. My brother also decided to join the Army. He's a little bit younger, and so at the same time, we kind of made this decision. And the Army was perfect. It was a great experience for me. I learned a lot, got a lot of responsibility really early. And I always think of it as an inverted career pyramid, where usually you have to be kind of far along in your career before you're in charge of a lot. You have a lot of responsibility. The Army, the Air Force, these kind of services, it's day one.
Well, especially as an officer, right? I mean, you're like right away, you're like commanding people that have 15, 20, 25 years of experience. They're like sergeant, master sergeants. And
yeah,
yeah,
absolutely. And command is, what you learn pretty quickly too is how to influence people inside of organizations where, yes, you could say, but like, because I said so, but that's often never a good place to be, conversing with someone with already. So you learn all these social skills, you learn how to manage, you get exposed to responsibility. And I, had a couple of lucky jobs. I got to do some fun things. I got to teach people to jump out of airplanes. And I knew eventually I wanted to go back to grad school. And unfortunately, at that time, there was a cut back in a lot of the grad school programs. And I had to make a choice. And I chose to get out and followed some friends and early mentors in my career and chose business school, mostly as a way to just figure out what I was going to do after the Army. I kind of was aware at that point that I liked systems thinking. I liked planning. I was a strategist in one of my last roles. And so I liked the idea of being a planner. But as I was going through business school and learning what all the jobs were, some of them weren't as interesting at that point, right? And the people that I found myself gravitating towards, the friends that I was making, they were going towards finance. They were talking about one day starting funds. And it's kind of like aha moment for me was, all right, this is what they're going to do. These lifestyles that they're planning on living, the things that they're planning on doing seem really awesome. And as someone who is a complete neophyte to the business world, I should probably pay attention to this signal. And so I decided to kind of create a career where I would gain a set of skills that in 15 years, my friends would want to hire me to help with them on their venture funds or real estate funds or private equity funds. And that was the loose idea. It was like, I want to work with my friends one day. They're gaining one set of skills. Let me go gain a different set. And so I kind of set out to go to JP Morgan to learn how family offices work, to learn how investments work, how they build, to just understand as much as I could as an early person there. Learned a lot of sales skills, how to talk about investments. JP Morgan really did put a lot of effort into training us, which was great. I got that entrepreneurial itch really pretty quickly after realizing what the business world was and wanted to join a startup. And a friend of mine was managing a Techstars chapter in Atlanta, and we made this agreement and it worked out really well on both ends. I helped out in a cohort for a summer, and then I got to meet 10 great startups and join one of them. And that was 2U Laundry. And we grew that business as quickly and as true to the startup story as I think any set of founders, Alex and Dan, could. We got caught out by COVID because we were a laundry and dry cleaning pickup and delivery service. So at one point, our business actually was illegal. Like we could not get all of our team in one place. We could not do some of the services that we want. And nobody really was doing dry cleaning anymore because everybody was working from home. And so the business had to change. And at that point, I had acquired a set of skills, learning about investments, talking to family offices. And I thought that would be helpful in the future. I'd been in a small business, helped build it from scratch with the founders, learned about tech stacks, learned about the finance and ops, grew a business and learned about this, how to deal with the systems that you need to build to make things work, right? Like you've got to manage all this data and use it to make decisions. So it's like getting the right piece of information at the right time to the right person to make the right decision. You got to hit all parts of that chain. And we were a really good startup. And that was really heartbreaking. And so I feel for all the founders out there that do go through that experience where you're building something awesome and it just doesn't, some macro event or some life event or something happens. But, for me, it wasn't the end of my kind of time as an entrepreneur. If anything, it kind of made me realize I loved being my own boss and wanted to continue staying in small organizations. I liked the building of startups. And a friend of mine asked me to help him do a CFO, COO business for startups. And our idea was to go to fund managers such as yourself and say, hey, you've got a portfolio. Would you mind introducing us to them if they need help in that pre-seed seed stage with a fractional COO, CFO? And kind of quickly, we got feedback from managers that they needed that help. And that's just some of the basic building blocks of starting a business, getting credit cards, expense reports. Everybody goes through that. And if you happen to understand the venture marketplace, the jargon, the terminology, the players, then you can provide similar services. And that was like the aha moment back in 2020 when I kind of started this part of the.
Interesting. I mean, that's a founder journey in itself, right? You kind of pivoted here and there, and then your startup shut down, and then you're like, okay, I'll do this for startups now because I know that they have this problem. But then GPs are like, hey, we have this problem, and I feel it, as a solo GP with three funds, lots of stuff is flying around, and we're not quite big enough to hire anybody yet. But at what point do you typically get involved with emerging managers like us, where like, hey, like the process and financial burden is probably becoming too complex or too onerous for you to manage on your own?
Yeah, I would say, well, I meet people that are fund zero that are just getting the idea together, and it's helpful. I can either speed them up or save them time. And you don't need to worry about this right now. Like kick that can down the road to next year, just focus on fundraising or whatever. I can help them kind of navigate those early decisions. And my business partner, Winter Meet at Coolwater Capital, like that's one of our specialties. We think as a team and as a platform is helping managers kind of get that first fund up. But then as you're going, you need kind of the way I describe it as a crawl, walk, run set of tools. And at the earliest stages, there's a set of Excel templates and things like that are helpful. Everybody needs to know their numbers. Everybody needs to know as a manager how much investable capital you have, what your expenses are, when the next need for a capital call. Like all of these things are pretty consistent, whether you're a CEO of a business or a GP of a fund. And so you need those early on, day one. So building a business that can help managers do that, but not be a full-time hire, which they could not necessarily afford. We've built a set of products for that. And then same for crawl, walk, run. We've got a set of services and tools that help managers at each stage. So I've got clients that are going on fund 3 and are looking to build institutional platforms. And so it's everybody in between.
How do your services differ between regular fund admins like Carta or AngelList or Decile? I'm on Decile because I went through VC Lab. My fund one's on AngelList. They seem to handle all this complexity for me. At what point will they not be able to handle that for me? Because I haven't felt it yet, because they're just they're already kind of doing all the reconciliations and accounts and systems. And, at what point, will I feel that pain? Is it going to be on my next fund where I have 100 million under management? And it's like, oh, okay, yeah, now it's, and I think you're legally obligated to have some sort of CFO, at least part-time, once you get to 150 million in management by the SEC, something like that.
I mean, there's a lot there. I would say there's two parts. So I describe CFO. Everybody's got a different version of it, but I think of it as a triangle. So at the top is that CFO, and just like in a pre-seed Series A, Series whatever company, you've got a kind of generalist or person who's maybe grown up in one part of the finance stack that sits at the top. That's either accounting or finance at a high level. So accounting, that is your fund admin, your audit, your tax. And it's mostly using historical data and producing financial reports, reporting out to LPs in some form or fashion. They've done a really good job of identifying what that scope of services is, automating it to the best of their ability, outsourcing it in some cases, but it's a very well-defined set of things they do. Part of that is not integrating necessarily between all of them and checking them. So a good part of what I do for my CFO clients is actually managing the service providers and any conversation that you would have otherwise been having with them. I take the brunt of the initial sausage making, and then you come in and we're presenting to you the finalized report ready for your review and approval, sign off, and let's go. And all of that other time is then able to be spent on deals and LPs and fundraising and podcasts and all these other activities that are higher ROI for you. And so that's part of it. So that managing those service providers, because there's lots of reasons why you would have those service providers, right? They have portals, your LPs like them, they have certain protections and SOC compliance and all these other things. So I very much need a fund admin and a tax partner to help do this. But then you've got the finance side of the triangle. And so that's things like FP&A, capital markets, lines of credit, managing relationships in certain parts of the finance sector, secondaries or QSBS specialists, or all these other things that are not necessarily accounting and not necessarily something that's in your scope of work for your service provider. And so we do a lot of that. And that's where I've kind of focused the practice. And the idea is it's about really wrapping our hands around your data and helping you understand it. Because that was kind of one of my roles in the Army, was taking this massive amount of information that would come in from my commander, helping the whole staff synthesize it and then presenting it back up to him so that he could actually make decisions and tell us what to do. And it's that chain I was kind of mentioning earlier. And so a big part of our business is actually kind of focused more on that finance. So I have solo GP clients, and what we're talking about week to week is, there's some housekeeping things like I just remember this stuff and I take on the mental load versus him, right? But we're also building trackers, we're reviewing, we're understanding who might be raising next, whose cash positions have changed since they last reported to us. And so me and my team are taking every founder update and email that gets sent to us. We're tracking it. We're tracking not only when did they send it to us, like how late before or after the period end, but how consistently, what metrics do we catch out of this piece of information from them? Do we get cash on hand, runway, all those pieces? And then we can tell our GP and portfolio reviews like, hey, they stopped reporting, right? They've been consistent and all of a sudden they stopped. And that might be for as your portfolio gets bigger with 3 funds and dozens and dozens of companies, you need to identify those hundreds of companies. You need to identify those signals to help you get to where you need to focus. Because if you're just letting this information just come at you like fire hose, you'll miss the opportunity.
Yeah.
And so that's really what I think a CFO does. So you can use that at any point, fund 0 to fund 3. It's just, what is the skill set of the partners? What are you out? Who's covering down on some of this stuff? And it's just different for every firm.
Yeah. That's interesting. So you also help with the portfolio financial side of it too, it sounds like.
Yes. And so I typically draw the line right now in my practice at deal side. So if it's an investment committee kind of thing, or if it's deal diligence, I don't do that. That's an associate. But I do the wire confirmations. I said, work with the fund. So I do everything behind that to support the whole life cycle. Yeah,
that makes sense. What are kind of the top 2 or 3 pain points emerging managers are consistently underestimating in this realm?
Yeah, generally, I think people underestimate the amount of data that they're going to have to go through in order to make decisions. And especially right now when there's all these conversations, there's mixed messages coming from the market. You have people talking about secondaries. You have firms struggling to raise right now is a big theme. You have round dynamics and AI companies versus non-AI companies. There's lots of divergence there. And so every quarter, everybody's kind of checking the big data aggregators and what reports they're putting out to see if there's meaningful changes. So there's lots of things going on. And I think people underestimate how much time and effort goes into essentially building your own intelligence network and like taking in information, assessing it, and going back out and trying to figure out different parts, what's happening, different companies that are raising, what's an appropriate mark for a certain thing. So you have this kind of system that I think people just misunderstand how they don't intentionally build it. That would be one. And then I think they misunderstand what LPs actually want from them. I think there's a lot of fund managers that would benefit from, in very strategic way, surveying your LP base. And it's like, what do you actually use me for? Because I think family offices, there's an old saying, you met one family office, you've met one family office. And so they have lots of different reasons why they choose. Some are very interested in co-investments. Some just like the sector. Some like the manager very much. There's lots of different reasons. So I think that's probably 2 things people don't do enough of, is like really care about the intentionality of their intelligence gathering and really care what their LPs actually want.
What is the best of breed platform out there to keep track of all this stuff? Like I've heard of like CRMs like Affinity that target VCs. There's lots of fund admin platforms, obviously. There's, lots of different CRMs. We kind of use a homegrown Airtable that I've kind of hacked together over the years now. What's your kind of preferred system to keep track of all this stuff?
I do see a lot of affinity. I think if you spend the time and build it out, just like Salesforce, so you can get some ROI there, but it is time intensive. I do see a lot of Airtable and just building things in Excel or Google Sheets. And again, it's a behavior driven. If you're not going to update the system, don't pay for something very expensive then. Pay for something cheap to if you're not going to update it. And
That's
then
what I'm always looking at when I look at Affinity. I'm like, how much is it again? Because I could just like replicate most of what this does in Airtable.
yeah. And you do have to piece together several systems. And so for you, what I think could be really interesting is a stack. AngelList is a phenomenal platform. I really like the team over there.
You know what I don't like about AngelList? I broke up with them a couple of years ago because they market to my LPs. Yeah,
Yeah, that's true.
not cool. Right. So like I bring an LP in that's not on the AngelList platform, and now all of a sudden they're just getting bombarded with offers from competing funds and competing syndicates, and just like it's not a good platform for GPs.
They still do that.
Oh yeah, totally. Yeah, directly competitive funds. Like literally, LPs afford me an email. Is this your fund? That's the same thesis. I'm like, nope, that's another fund. So yeah, I do not recommend AngelList to any GPs like me.
Okay.
Although you're right, their systems are amazing. Like I think it is one of the best in class software systems. If you don't mind being just a cog in the AngelList system.
Okay. I mean, I can understand that. Well, so then I would posit it back to you. I haven't heard any system that has 100% likability.
Yeah.
I mean,
that's why I think I'll always kind of just build my own thing. That way I know I own it. I can customize it exactly the way I want. I can hack stuff together. I can vibe code stuff in Airtable if I need to, like not that hard now. English is the hottest new programming language.
I mean, there's a lot of AI fund admins now. I think so the way I think the whole market works is generally I think LPs are cautious. No one wants to be the first egg broken to make the omelet. And I think they're justified in that. But I think there are some interesting AI tools that would allow someone like yourself to be a very lean team. I've generally found so far with some of the tools, the service providers out there, that if you think you're getting in a tremendous value or deal, you're probably not. The joke in most of the operator circles is like 50% of people love Carta, 50% of people hate them. And you could say that for a Duro, for a number of different fund admins. I mean, everybody went through COVID in a different way. A lot of the fund admins and a lot of the auditor and tax firms were competing for talent. They were raising money themselves. They were being scooped up by private equity or minority investments. And so there was a lot of momentum and energy and urgency that went into building bigger and bigger systems and teams and platforms. And that caught a lot of people out, burned out some folks. And I think we're still dealing with a lot of the bad quality that came from that, and some of the turnover that caused a lot of GPs to be super frustrated. So yeah, I mean, I hear your complaints about AngelList. And I understand the desire to build everything in-house.
Yeah. If I could go back and start Team Ignite all over again from the beginning, I would not be on AngelList 100%. I would have just built it on my own. And somebody warned me of that back in like 2020 when I started. Like, yeah, AngelList is great, but yeah, they will cross market to your LPs. And I'm like, well, they also have LPs. So, so you kind of like, it's a great way to get started. Like if you're just getting started and you have no network, you have, no rich people, but you got good deal flow, AngelList is a great way to get started. Yeah.
Family offices will get, one that's let it known that they're receiving pitches. They'll get as many pitches that VCs get for startups, right? I mean, they'll get it for every asset class. They'll get it. I understand AngelList cross-selling is not great, but your LPs are getting pitched by everybody anyway all the time.
Yeah, it's you got to get an intro there. I've done the cold outreach to family offices. It does not work. Just they won't respond. So you got to get an intro. So if you're a GP listening to this, get an intro. Just like founders, right? Founders are trying to pitch a VC. Like I do look at all my cold inbound, but I run it through my Airtable with AI. And so like, I don't technically look at everything. I probably look at the top 10 or 20% of what the AI thinks is the top 10 or 20%.
How much time and effort do you spend on training and retraining the AI to a set of standards
all the
and criteria?
We're on like version 25 of our prompt for O3, so it's a lot.
Pretty methodical, like how you go through and determine. That's awesome. I applaud the effort there.
It's like a 2 or 3 page prompt that we've built up now over thousands and thousands of deals, and lots of deep research, lots of integrating other people's frameworks on how they evaluate startups, trying to kind of check all the boxes. It can't make your decision for you, but it can prioritize things for you, I think, and give you insights that you normally wouldn't do. Speaking of AI to streamline operations, so I used to hire interns, and I still do. I still have some interns, and they're great. But I used to like really prioritize having interns on Team Ignite. These are MBA students and their first or second year. And I would use them to go to demo days and do my due diligence, right? Dig through the data rooms and kind of go check everything. But now O3 can just do that. I just dump it in there I have another prompt for due diligence. I have a prompt for evaluating, and I have a prompt for due diligence that I've built up now over hundreds and hundreds of diligences that we've run. And it does a really good job. Like it just kind of goes through the whole data room and says, okay, here's a yellow flag. Here's like an issue. Here's a red flag. It's amazing.
Yeah. Yeah. I actually was having a conversation with a manager today that we wonder if very quickly it's going to get to a point where, every manager I talk to wants some sort of AI parsing tool to parse through founder emails and updates to help them, especially if you're a fund of funds and you've
Oh,
got
yeah.
15 or 20 underlying managers and so how do you parse through all of that? And like that makes it a really interesting use case when you have, but you can imagine a certain future state where founders have an AI tool to create LP or investor updates, and LPs and GPs have a AI tool to read
Yeah.
them. And it's just
And
like,
that's fine.
you could just have
They're just
that
like
Google
APIs,
signal code.
basically. Yeah.
Absolutely. But
Yeah.
I think you might actually get much better reporting at that point, because so much of the kind of drama, both from founders to GPs and GPs to LPs, is that moment when you're like, I don't really have great news, or the news is kind of, but more often than not, they wait to send that update, and they should, right? Like you should ask for help from the people that have invested and are aligned with you, hopefully if they're good people, to help you. But the numbers also should just be reported easily. Like
You
I
can't do it
think
by
that might,
yourself. I think the
no.
takeaway there is you can't do it by yourself. Don't try to do it by yourself. Even if you're 2 or 3 founders with a small team under you in your seed stage, like just ask for help. Just be like, hey, we're really struggling with this channel. Do you guys have any ideas for other channels we should try? Like just being open and vulnerable can just lead to lots of good things, because you probably have 30, 40, 50 investors on your cap table by the time you hit the A round. So just leverage that network and get help.
All the GPs are out there saying they have a great network. Ask them to put
Yeah,
the
exactly.
proof
Yeah, it's
out
in our
there,
name,
right?
right?
So,
Team Ignite, right?
right, yeah.
Back to the processing of updates. So we have 220 portfolio companies, something like that now. So it's quite onerous, and we already process everything with ChatGPT effectively. So I haven't wired it up to be automated. So I have my assistant doing it. Like she monitors the portfolio at teamignite.ventures, and she'll process it for me, enter it into the Airtable, and then forward me the update in a digested way, in a way that I can consume it very quickly and figure out like, how are they doing? What do they do? Because there's 220 companies. Sometimes I forget. What do they do? How are they doing? Where do they need help? And here's our like response to help. Yeah. So it's already all like, eventually I'll sort of wire that up in a more automated fashion. There's always this last mile problem with AI, or the last 4 inches problem is what I call it. The last 4 inches to the keyboard. Like you kind of need that human in the loop to kind of steward the AI through things. Yeah. But eventually there'll be agents, swarms of agents. Talk about institutional readiness, what that actually means, because I'm about to do this and I need to get institutional ready. So what does that mean?
Okay. Well, first we should clarify, what kind of LPs do you classify as institutional, and so what LPs are you talking?
Yeah, this is for a much larger fund, $100 million fund in the future. I'm not fundraising. So the SEC is listening. This is not a public fundraise. Hypothetically, if I was raising a $100 million fund and I was going after the 5 and 10, $20 million checks, what do I need to have? How do I get ready?
Yeah, absolutely. So those are the types of LPs where they're kind of in the messy middle, right? If they're writing very large checks, they're usually following ILPA guidelines or some other kind of industry association guidelines. And so there's kind of a known playbook. If they're high net worth investors, it tends to be a lot less structure,
right,
and more conversational in the updates you provide.
Let's talk about the former. What are those guidelines? I haven't heard that phrase before.
ILPA?
Yeah.
ILPA is the Institutional Limited Partner Association. So it is the trade arm so Venture has National Venture Capital Association. ILPA is for the broader private equity umbrella. And so think of the $50 to $100 million check writers.
And
so this is their
the $500 million, $1 billion funds and up kind of thing. Yeah.
Well, the LPs that invest into them.
Right.
Right. And so it's a trade organization that is sought to sought to bring, clarity and common understanding of expectations between GPs and LPs for reporting, for use of fees, for all these different things. They're very active in, shaping SEC regulation. They're like the National Venture Capital Association, but for very large, limited partners. So their members are, the large endowments and foundations and universities, sovereign wealth, maybe not sovereign wealth funds for ILPA, but there's a lot of very large pools of money. A lot of their expectations around reporting is their own template that you can give to a fund admin and be like, please fill out this template for this LP, which might be different than the standard reporting that you send out. And it's the same information. It's just in a different format that they're using to update whatever CRM investment tracking tool they use. And so they're large enough that they can get special treatment. They ask for it. That's kind of the larger. And so I would say your messy middle, these are people that are often invested in other private equity funds, real estate funds, they're in hedge funds, they have publics. So they are seeing a broad market. They're not just high net worth investors that have a personal connection. So you're being compared against other managers in other asset classes, some of which are more mature, some of which are much bigger than you, have more resources. And so you have to kind of keep an eye and understanding of that, what your LPs are seeing. And so that would be my next thing. And then as you get more and more specific, it's really about figuring out almost like a syllabus in college. You go to syllabus week, the teacher hands it out and they say, you got finals, midterms, you show up to class, you get your attendance point, and they give you the weights. And the other piece of this is knowing that you can outperform at some parts and just kind of get the point for others, right? So on a final, you can study, you can do really well, you can get 100, somebody else gets a 50. It's a measurable, demonstrable change, and you get rewarded for that. So figuring out what that rubric is for your LPs is kind of critical. So I would say what some big themes that the institutional LPs care about are they want to make sure that the business operations are well run. They're going to write you a large check, $2 to $5, $10 million. They want to make sure that your service providers are competent and well known. They want to make sure that you've got policies and procedures in place. So you've thought through operational playbooks. They're kind of relying potentially on some of the larger fund of funds or people that have formal due diligence teams to kind of double check some of that stuff for you. So that they may ask to see your DDQ. They may ask to hear how some of those conversations have gone. And what they're trying to make
what's the DDQ? What is that?
Oh, DDQ is everyone's second favorite acronym in fundraising after PPM. But DDQ is the due diligence questionnaire. So can be a 70 to 100 page long document that is a questionnaire that LPs will ask you about your business practices, how you invest, how you make decisions. They'll ask you standard questions about disciplinary things and past behavior. Have you ever been arrested? I mean, it gets really in depth because they want to know who they're doing business with. And so you will fill this out and put it in your data room so that LPs can read it. It's a big part of it. The other one I said was private placement. It's a part of marketing material that larger LPs and other asset classes do quite often. Venture sometimes does, sometimes. But
that's amazing.
Yeah, so they have expectations for how well you run the business. So they're going to want to see a playbook. They're going to want to know that two people have to check a wire and release it so that not one person can set up a wire and wire themselves the money. They start to want to see real business processes that maybe in a early syndication fund or as an angel investor, you didn't have to concern yourself with because you didn't have anybody else's money necessarily. So they want to see that stuff. So they care about your business practices. They care about your decision making and how you manage and control your data, because that helps them understand and assess whether you're predictably making good choices and over successive funds that this is a place that they can continue to put money to get access to a particular market or a set of risk return parameters that they're looking for. They don't want to every 3 years have to go find another person they're going to trust with a large sum of money. They'd prefer if they could trust the same person consistently. And so a lot of that is
or the same
doing
firm.
what you
yeah.
Right. And that's what same firm. And so doing what you say you're going to do and being able to demonstrate that. So investment, they may even ask for, in some cases, the voting records from your investment committee, depending on how your firm is set up and if those things exist, right? But if you tell them we do X, they're going to go, great. Can I see the proof of it, right? And that's part of that due diligence process with large institutional investors.
Well, they asked to see the deal memo. Like we do 150 investments per fund. Well, they probably won't want every single deal memo, right?
No, they'll want a couple samples.
Yeah.
Like they may even say, give us your best company, give us your first zero. And the goal of it is so they can come prepared to a conversation when they go, all right, why'd you make this choice? Why'd you decide to follow on in this company?
Yeah.
What
They
about
love
it?
my data room because I don't have that many zeros, but when I do get one, I meet with the founder and I actually write a postmortem as well.
Yeah,
It's kind of like,
here's
here's the deal memo as we went in, and here's the postmortem of like what went wrong here and what we learned.
Yeah, I mean, I think that's wonderful. I think that would make me feel good as an LP, knowing that you have a process and you stick to it and you're disciplined and you're diligent, right? And then the last piece is how you communicate, right? They need they need you to communicate to them. And some of them have different reasons why. So maybe some of your LPs at the institutional size are really interested in co-investment. And so they may even work that into the negotiations with you as an anchor LP, that they get certain co-investment rights. You need to have a program that then is built to capture the information, present it to them, track that you're, getting them this co-investment. Like that's a whole other thing that you've agreed to do. And so you have to have systems to help you do that, right? Maybe they just want quarterly updates about the market. They're using you for the investment return, but they're also really curious about what you think about a particular sector or theme. And so they're paying you as a manager. They also want your insights and knowledge. And to some degree, I think managers owe it to their LPs to communicate quarterly and like tell them what's going on outside of just the metrics and the bare bones.
I tend to do the newsletter on the fund based around the capital call. So it's like, okay, I'm calling capital twice a year for my main fund, so I'm going to write a newsletter twice a year, kind of ahead of the
Perfect.
capital call. Here's what happened since the last one. Here's what's going on. I have another fund where it's more like quarterly capital calls. So I feel like, hey, if I'm going to ask you for money again, I'm going to write you a newsletter and tell you how it's gone.
Yeah, I think that's wonderful. Yeah, no, that's exactly it. So those are kinds of, because at the end of the day, LPs and institutional LPs, they only can look inside your operations, but so much. And they get to do it the same way GPs do, is during diligence before you write the check. But then if you're not necessarily a board member close to the founder, you may not get all of the updates or know all of the information. And LPs are in that same relationship. And so the lower the barrier you can make it, the happier your LPs will be, right? They want to know what's going on.
So walk us through the anatomy of a great fund dashboard. What actually matters for LPs?
For LPs or for GPs?
For both.
For both, yeah. So I think I would imagine as an LP, you would want to be able to log into your portfolio, your portal, and I'm not a portal product manager, but based on the questions that people ask me, they want to be able to go look for their documents. So anything that's been posted, historical K1s, audited financials, letters, amendments to the documents, whatever. They want to be able to quickly go get them. They want to be able to see some high level health of the portfolio. And there's only but so much information you can share, because there are reasons why you would or would not share lots of different pieces. But they'd want to be able to
I'm not
see.
going to share all the nitty gritty of every single startup, because they're kind of on a need to know basis there. They don't need to know that the company grew 10x year over year. You just need to know that, hey, we're marked up 10x. Yes. But you don't need to know that they went from $1 million to 10 million of ARR necessarily.
And to some degree, people can infer and imply as they need, but like your job isn't to know. You might have LPs that are competitors or might have other competitive investments. And so you have to be mindful of that for your founders. So I think as an LP, there's a simple table of information that most of them want. And it's shorthand for it is PCAP. So it's the partner's capital account statement. So it's just their pro rata. So if it's a $100 million fund and they own 10%, they'll see all of the investment costs, the expenses, the management fees, and they'll see 10% of their part of it. And they'll kind of be like a little mini pro forma P&L of where their balance stands. So that's definitely something LPs care very much about. And then I think they also like to understand what I tell managers in a quarterly update, because that's really where LPs kind of get this information, is in newsletters or quarterly updates, is like you're telling them a 3-part story. It's, we told you we were going to do X, Y, and Z when we first agreed to do this deal together. Here's the proof, and that we're sticking to what we said. Check size, number of deals, stages, industry, time diversification, geographies. Like you kind of show them charts and graphs and tell that story. Here's what we said we're going to do, and here's the proof that we're doing it. Then it's the metrics. Where's the fund marked at? And there's kind of a few metrics that are really critical for venture capital, and that's TVPI, which is the total value to paid in capital. So it's how much the fund is worth versus how much did they put in there to get it to that point, right? And so that's a very high level gross understanding of how the fund is doing. And then you've got MOIC, which is just a little bit more specified, it's multiple on invested capital. And so it's just slightly different denominators and what you're measuring, but it's more of a measure of how good of an investor in selecting you are for the dollars you put in, what's the multiple on those dollars. And then lastly, IRR, which is a great way for LPs to measure your particular fund and your asset class at venture against other types of asset classes. And so it's good to understand, what the IRR of a fund is. If it changes, that tells you something. But generally, the idea is real estate's at 15, the S&P is at 11, and venture better be at 22 for the illiquidity premium, right? And so that's what people use the metrics for. Some are for understanding the exact fund, some are understanding the fund's placement in the broader kind of private equity.
Now, before we continue, a quick word about an incredible resource for startup founders. This episode of the Ignite podcast is brought to you by Build, spelled BYLDD. So, what is Build? Well, they specialize with early stage startups, especially non technical founders and teams, helping you build and launch scalable revenue generating software fast and affordably. Most startups can't afford to drop 100K on some big design engineering agency. Freelancers are risky, inconsistent, and full of project management headaches. For 10K in about a month, they can turn your validated idea into a real market ready product. It's built for scalability. Past clients have been accepted into YC, Y Combinator, very impressive, received backing from Google, and raised multi-million-dollar rounds. And there's an exclusive offer for Ignite listeners. Get a free UI UX design sprint that's 3 to 4 weeks, a deep dive into your product experience, delivered completely free. This is normally a $10,000 plus service. So head to byldd.com, connect with the Ayush and team, mention the Ignite podcast. Let's get back to it. How do you calculate IRR? Because that's kind of, it's based on cash flows, and venture funds take a long time to cash flow. So do you kind of use a cap adjusted basis for like, hey, they raised a Series B at a 400 million and we invested at, 10. So it's a 40x. And if we exited that round, let's say in that Series B, we could have just sold our entire position, which is pretty typical for a pre-seed seed. Do you kind of take that into account? Like, because IRR, typically you have to have a cash flow to calculate it.
Yeah, absolutely. That's all you do. I mean, typically for the IRR profile for a venture fund typically starts out at zero. You do your first capital call and you'll get a couple of wonky numbers early on as cash comes in, your net asset value goes up, but there's no investment and the IRR calculation is kind of incomplete at that point. And so you kind of get these weird wonky numbers, but effectively it'll at some point go severely negative because you're effectively paying money into the fund, but there's no return cash flow back. So for a period of time, the IRR will stay negative. And after, typically for a pre-seed seed fund, companies are marking up 18 to 24 months. So usually those first 3 years, as you're building the portfolio, you're paying management fees and expenses, your IRR is dragging down. And then you'll start to see some of those pre-seeds become seeds become Series A's, and their valuations go up. And then you own a portion of that valuation. And so what we do is we sum up what your fair market value of that,
kind of
ownership
the latest market, unless it's been impaired or they haven't raised in 4 or 5 years or, stuff like that.
Correct. And with my clients, with my managers, we will look at them quarterly and assess it. Did we get an email from a founder saying it's been impaired or they're shutting down? Or did we see some news article where they did something really, really bad, right? Like, do we know of anything? All right. If we don't, then we go to our valuation policy and we look at how long has it been since we last changed the valuation. And then we kind of work through a decision chart. And do we have to get to a point where we're making a valuation adjustment here? Is it GP discretionary or does it kind of follow our process? And we can just say, right. And so we go through all of that quarterly, and then annually we're going through it with our auditor as well, typically for audited funds.
Oh, but basically you will use kind of the latest cap unless there's some other information to lower that.
Yeah, no, I mean, your fair market value, the sum of the fair market values of those positions is your fair market value of your portfolio. And that'll be the terminal value in your IRR at that point.
No, that makes
sense. That's like the outgoing cash flow at the end that allows you to do the XIR.
Got it. Let's talk about market trends. So LP expectations are ever shifting, especially over the last 5 years. What are you seeing out there with these expectations?
So I think every fund is taking much longer to close. I would say the manifestation of LP expectation there is if you are really differentiated and you can show a clear path to driving alpha and why you exist and why now. Just like for a seed or Series A company going through the crunch, I think those managers are able to raise and do well. And there's a lot of managers that, their LPs the sand has shifted under their LPs' feet and they may or may not, be interested in venture anymore. So those managers are now trying to build new relationships with new LPs, and that takes time. And so I think there's a lot of different things going on. But if you can prove that you're differentiated and that you have a clear path to driving repeatable alpha, then that is still exciting for LP. And then other trends, I would say, hopefully, what I think people are starting to recognize is what I call once bitten, twice shy. And that there was a lot of bad behavior in 21 and 22. And aside from the valuation stuff, I mean, just reckless use of expenses, people kind of doing blatantly illegal things, right? Like there was all that bad behavior as there are sometimes in manias. And I think LPs have experienced that and are now once bitten, twice shy. And it may not have been in venture, it could have been in a different asset class. But I think their expectations for transparency, for things like wire fraud prevention, for cybersecurity prevention, I think now the expectations are going up for managers. You have to run a real business. You can't just be, two people in a checkbook writing checks up and down Silicon Valley. You actually have to run a business.
It's interesting, venture capital. Why do you think that so many VC firms fail to beat the market? Like, and when I say the market, I mean like NASDAQ or S&P 500. Because
Yeah.
I think the median venture fund is basically like a 2x fund or something like that.
I mean, I have a weird take on it from my time kind of learning about investments is I think venture should be a 3 to 5% of a very large portfolio, and it should be the money that you are putting out there for quote unquote the flyers. You shouldn't have 30% of your portfolio in venture, and I don't think like Harvard has that kind of situation.
I think
But
that's exactly what Yale allocates.
Yale has a large portion for private equity, but they just actually announced they're trying to sell about $6 billion,
Really?
six
Wow.
billion dollars of their managers. So even Yale is starting to reduce down that private equity exposure broadly. But they're also no one should compare themselves to Harvard and Yale. Those are two different. Those two portfolios are in different worlds from the rest of us.
I was curious to get your thoughts because my theory is, and I've written about this, is VCs are too concentrated, right? They make 15 or 20 investments, and it's just not enough to hit the average of the asset class because it's such a power law. Like you said, 22%. That's depending on the data set you look at. It's like 18, 22. I've heard 25, 30, over 10 or 15-year time horizons for venture capital as an asset class. And a lot
18
of these
to 20 is a 3x. 18 to 20 is a 3x fund. A venture timeline. 25, 27 is like a 5x fund. It's kind of the way the math breaks out.
Well, yeah, I think if you're at 18, well, rule of 72, right? You double every 4 years, so you double 2.5 times. And I think if you're at 20, you're doubling roughly every 3 or 4 years. So that would be a 4 to 5x gross fund. So like I think if you're hitting the averages of the asset class, you should have 4 or 5x funds. But I think where VCs go wrong is they concentrate and they think they're really good at picking and adding value. And I think it's a fatal assumptional flaw that GPs make. And so
Yeah, I mean, I call it.
Yeah.
I think of it as strategy and coherence. So I think like you have a strategy that is logically coherent, that you build a large portfolio and you're very early and you're not doing a lot of follow-on bets, and there's like a very specific strategy of portfolio design that you're following. And then I do believe that there is a concentrated portfolio. Some people may not even call that venture. Some people might call it growth equity investing. But that's what growth equity investing is. They'll have 8 to 10 companies in a 300 or 400 million or $500 million portfolio. And what they're doing with a lot of the extra cash after that first investment is protecting their position. Because the one thing that I've noticed from my seat is it appears that the very large institutional venture banks, venture funds, private equity crossovers, they're wedging out parts of the market and downstream investors. And there are crossovers. It's not hard and fast. It's not, feudal kingdoms here, but people are starting to line up. And once you kind of identify as a large company that needs a lot of capital, who that venture bank or fund is going to be, if you're not in that kingdom, you're going to have to protect your investment because you don't necessarily have a seat at the table when the next structure comes around. You may not even get an opportunity to pull through your preferreds. There's a lot that happens at Series C through IPO that what you're effectively telling everyone now is you're probably only going to own common shares at any IPO. And that's fine. You're going to own a lot of different companies.
Well, everybody gets crammed down to common at IPO, right?
Yes, but there's lots of different things that happen before that, different lockup periods, who can distribute shares. There's lots of different things that preferred shareholders will get rights things to that you won't necessarily, especially if you get crammed down to common super early. Right. And so, but again, what I think the people make mistake is they blend the two strategies. It's like you shouldn't be a growth equity investor style at pre-seed, and you shouldn't be a pre-seed style investor at growth equity because it won't work. And everybody just says venture capital, and it's not all the same. It was 25, 30 years ago, but now when we talk about the private equity marketplace, there is a strata and level of classification on the market. It's not on the quality of the investor. It's like where they operate in the market. That venture should have that exact same thought process. Pre-seed and seed are completely different than D, E, and F rounds if you're working with Franklin Templeton and Goldman Sachs and Andreessen. Like that's not in venture anymore. And you as an investor at Team Ignite, they probably wouldn't even let, who knows what they will even let you into the building, right? Like they may just like lock the doors and not even tell you where the meeting is. So I think there's two different strategies, and we're just not specific enough when we tell people. We just say VC, and it's just not VC.
That makes sense. So how is the rise of solo GPs, rolling funds, these fund 2, 3 transitions changing your work?
Yeah, I love solo GPs. I think it's a great thing for the asset class, and I think we're building a lot of tools that make it easier for you to do your job. And you've highlighted several and proved in case right now. I mean, you're a proof point for my hypothesis. And so I think solo GPs are a fantastic addition, especially when you couple the idea that they have a unique network and operating experience that can help specific companies. And I think that is a way that LPs respond to your ability to generate alpha is it's me, and for the next 12 to 15, 20 years, you're on this ride with me. And I think LPs like that, especially heads of family offices who've also gone on that entrepreneurial journey and built something, right? They appreciate it. I think solo GPs are great. I think fund twos to fund threes, again, the old days of GPs being able to just focus on a small network in a tiny city on the West Coast is over. Like you have to build a business, you have to get your brand out there, you have to be a magnet for the best founders to come and want to work with you. They have to know who you are and your story. You have to show that you can add value. You have to be a good participant on boards and in other rounds. There's a lot that you have to do as a GP
No
that you
boards for me.
didn't.
No boards. Thank you.
There you go. Well, even boards for different conferences and events and things like that, right? Like there's lots of different reasons to be on boards besides just company boards. But I think it's just getting more complex. And if you don't recognize it and attempt to build systems and lean into the complexity, those who do and do it well, like are gonna crush everybody. It's not AI that's gonna take all our jobs. It's people with AI are gonna be better at the jobs they're gonna take.
Man, if I had $1 for every time I hear that, $1,000,000 by now.
Do you believe that?
No, yeah, I mean it's so obviously true that like it's everybody says it. You have in the notes that you don't like rolling funds. Why not?
I think they're overly complex for the part of the asset class that adopted them. So
Yeah. I wish I didn't do a rolling fund for my first fund, actually, in hindsight. It was my first fund. I didn't know any better. I was like, oh, that seems reasonable. Commit quarterly. Yeah, they have a very high fee load. And then they really hurt your TVPI. My TVPI on my first fund is 1.25 and my MOIC is 1.8. So that delta right there just tells you how much fee load is at the front end of that rolling fund.
yeah,
It's
yeah.
quite onerous.
And same with the founder roll-up vehicles. I think that was a ZERP era phenomenon. I think founders can be tremendous pickers based on their WhatsApp group or Slack group or whatever they're in. I think they understand their industries and sectors incredibly well and can probably see and understand what will succeed. I don't think you can be a part-time fund manager and meet your fiduciary duty. And so I think like those probably will also probably wane as just a ZERP era phenomenon and the founder roll-up vehicles. I think there's a lot of people now that are chasing K1s all summer and trying to track down all these things that you're just like,
I hate
wait, I don't
founder
even
roll-up
have.
vehicles. I have unfortunately had to go invest in a couple, but yeah, that's not a good thing for GPs to do.
Yeah, and I can't tell you how many GPs are like, I warehouse a bunch of investments, and it's not direct shares, and now we have to like be very specific about how we bring them over, and you don't get QSBS treatment, and there's all these other considerations that founder roll-up vehicles don't. It would have been better if they just sold shares to everybody.
Yeah, your front row seat on AI actually changing the back office operation today. Like, what are you seeing out there, and how is it moving the needle right now on
Yeah,
operations?
I'm probably a broken drum in the sense that I feel like AI has been around for a while in accounting because it's one of the perfect places for it, known set of rules, consistent inputs and outputs, and so QuickBooks and Zero, those tools have gotten really really strong. I've started to see a lot more autoresponders from service providers. We've got your request, we acknowledge it, we'll get back to you. That's definitely better than just sending things to a black box and not sure that the task is being tracked at all. But I'm now able to like, oh, I got a notification back. I can log into a portal. I can see the like a Jira ticket or some variation of something. That's definitely helpful. Makes me feel better that my questions are being answered or dealt with. I'm seeing a lot of AI tools like Affinity where they try to bring in data and enrich things, but you still have to have a human in the loop because there's a lot of like consistent name, a lot of Johnsons and consistent names, things like that you have to work through. Well, I would say I see a lot of LLM use for investment memos, as you said. That is, we were just talking about it the other day with some folks where the market research aspect of it is really, really helpful. I mean, you can cross do this on 2 or 3 different models pretty quickly and relatively cheaply. And kind of make sure you're getting similar answers. I think there will be very soon, the multimodal stuff for finance will be really, really good. Even now, like just basics are moving the venture community forward. It doesn't need to be rocket science, just
Well, let's talk
fun.
about leadership. Back to your kind of Army experience, how you kind of apply it now. I mean, you've led in war zones, startups, fund ops. How do you approach decision making under pressure?
I mean, for me, the key is definitely figuring out learning how to make those decisions ahead of time, being pre-prepared, right? And so back to what you were talking about earlier and understanding all of the different companies that you have and using an AI tool to go through all that information and pop up the signals for you. A tool that I would build or had in the Army and that I recommend founders or whoever have is what I call like a decision support matrix. And so you list out what you think those critical decisions are that you can plan what your response will be. And it's just a series of very simple if this, then that's. And so one of them might be speeding up or slowing down your deployment model, writing a smaller check. It might be something urgent about an immediate follow on. And you can pre plan how you will deal with a founder calling you on Friday saying, hey, there was a mistake. We got fraud. I'm not going to make payroll on Monday. I need $50,000 tomorrow. Like, what are you going to do in that situation? It may not be that exact thing. There may be some context, but like thinking through your chain of events. All right, here's what I need. Here's what to activate. Here's how I would try to pre-understand this information. Here's what pieces I need to actually make the decision. And so when it happens, you can just like walk through the steps. And you're not trying to solve it in real time. You're just following your plan. Like, that's the key. That's how you lead under.
Of that. And what's your mental model for prioritizing in chaos, especially around early stage fund building?
Yeah, fund building, company building. I think I typically like to think of it in two parts. One is you need the right people. This is like a good to great kind of mentality, get the right people on the bus. And I personally want to try to balance out skill sets and what people are good at. I know where I'm good at. I have a person that supports me, Jillian, who's fantastic at a lot of things that I'm not strong at. And we are a great team together. And so one, you got to make sure you bring that right team together. And if you do that well, then the prioritization piece works because now you have some folks that are big thinkers, long horizon, strategic, working on important problems that take a long time. And then other people that are very task focused, next 25-meter target, and are very urgent focused. And so you can prioritize things by the people doing what they're best suited at, but like what's urgent, what's important, what has to happen now, what can wait a little bit. And that's kind of where I think that's best you can do at early stage, right? Like everything else, figuring it out.
Speaking of which, what's the most counterintuitive insight you've learned being on both sides as an operator and an investor?
Yeah.
You talk about the micromanaging kind of way, but in Coach Wooden, I don't know who Coach Wooden is.
Okay, great. All right. So the most counterintuitive insight that I kind of have learned managing a lot of 18-year-olds that have a lot of energy, also managing young professionals in a white collar workforce, kind of doing both in a services, tech enabled services business is I think the best organizations in the world, they actually focus on the minor details. They aren't trying to do super complex things really quickly, but they're trying to get the crawl and a crawl, walk, run progression perfect, right? So one mental model I have for this is Coach Wooden at UCLA back in the 50s and 60s, he won like 11 national championships in basketball, dominated for a long period of time. He was known for teaching his players how to tie their shoes and teaching them the correct way to do it. Because if you tied your shoes correctly, you limited rolled ankles, blisters, which meant less missed practice time, which meant that you could have a more consistent practice squad and build better plays and then ultimately win games. And so they focused on the things that were small instead of trying to build this most insane game strategy that perfectly outthinks the other team. They just make sure their players are doing the basics incredibly well. And then I saw that in the Army. You'd go into an operations center and something is happening and you would expect it to be chaos. And that's probably what the movies show because that's like exciting. But in the best run organizations, it's like a library, right? Everybody is focused on their exact job. They know what they're supposed to do and they're focused. And I think that is the key to the best firms out there is they just know what they're good at. They do it really well. They focus on the basics and they're just like repeatable machines. And LPs will love you if you do that because they can count on you. Like that's like the
Right.
key.
I love that. Well, let's wrap up with a rapid fire. What's one non-obvious metric every emerging manager should track?
Yeah, so I like this idea of doing plan to actual, especially on budgeting, but expanding it out from budgeting. You could think of it as your ability to create a plan. So let's do deployment pacing or check size understanding how you want to write these checks, how you need to meet companies and get them into your pipeline and do the diligence in order to meet that timeline of when you need to deploy your capital into different companies, and then how you actually do and understanding that plan to actual. And then from year to year and fund to fund, are you better at planning that and then actually executing to that plan? So it's kind of like a second derivative understanding of it, but it's you getting better at actually planning what you and doing what you say you're going to do. No one's perfect, but you should be able to get that volatility narrower as you go on. So I think that's kind of like a pretty interesting way to try to get better.
What's the biggest myth about being institutional ready?
That it's an AUM requirement. I know $25 million funds that run like Swiss Army watches. Their LPs are super happy. They're doing advanced things. They're just a small AUM fund because that's the right size AUM for the strategy they're employing. But institutional, I think, is really more about systems.
What's the most overhyped tech tool in fund ops today?
I personally think right now it's just not good, but anything that does email parsing for KPIs, I get a lot of people ask me for like the AI tool that solves the KPI problem for both capturing KPIs, requesting them, going through them. And I haven't found anything that is both cost effective and something that a lot of people could do and set up.
Yeah. Just send it to ChatGPT and have a human review it, honestly. You literally, yeah, you need to have ChatGPT process it, but then you have to have a human read it and double check it because sometimes it'll get it wrong. It'll be like, oh, ARR is 5,000, or 5 million. I think in thousands.
We could poll 5 investment bankers and I don't think they'd give you the same definition
exactly.
of ARR. So like there are just lots of definitions.
Most underrated trait of a great fund CFO.
I think they need to be a systems engineer. You can be a great accountant, but you hire a lot of accountants. If you want to be a CFO, you need to be strategic. You need to be building the system that other people operate in. And so you got to think of it as like a system of inputs and outputs and decisions and reports and building like an architect, not just an executor.
What's the best investment decision you've seen made based purely on gut and ops insight?
So this one is a little weird. I really enjoyed this question when I was thinking about this. So I have this friend. He went to a rooftop party in like 2007, met some people. They told him about some company they were starting. He went out to interview in San Francisco, didn't get the job. He wasn't a computer engineer, and they decided at the last minute they're just hiring. So about 12 months later, he's at a wedding, same consensual group of friends, the same network. And he talks to one of the other guys and he says, now we're hiring business people. Come on out. So they move out to San Francisco. He was in banking as 2008. What are we going to do? They moved from New York to San Francisco. He ends up living in like a very famous apartment that another founder had created, created a marquee company that we all know about. He lived in that apartment. He ended up joining Palantir. His wife got a job. She ended up being a super low number employee at Stripe. And it seemed like the best decision I've ever seen anyone make is they moved out to Silicon Valley at the right time. And they just happened to get into some amazing companies.
And they're great. The underlying story there, which I think is interesting, is the network, right? Saying yes to going to the rooftop party, saying yes to going to the wedding, because you never know who you're going to meet. And taking chances too, right? Taking a risk on moving across the country and working at a startup. Yeah, I wonder what that decision-making process was for them. Like, did they know it was promising, or they're just like, hey, this seems cool. We're going to give it a shot? Or
I haven't asked them that question. I would imagine it's some form of being in investment banking in late 2008 probably wasn't super, there wasn't a lot. Yeah, there wasn't a lot of optimism, but I mean, I don't know that there was any optimism. I remember being a lieutenant in the Army in 2008, going back to Afghanistan after mid-tour leave, being like, this place seems like it's a little dicey after seeing the S&P drop, whatever it was. So yeah, I don't think there was any easy choices back then.
That's crazy. Yeah, good for them. If LPs had one dashboard widget and nothing else, what would it show?
I think it would be some form of like a bullshitometer, some way to do it. You got to create an algorithm that's some metric of, does this LP do what they say they're going to do? Like they say GP. They're going to send a quote. Yeah. The GP. Yeah. Does the GP do what they say they're going to do? Do they send their quarterly update on time? Do their K1s come on time? Do they pass their audit? They said they were going to do 20 companies. Did they do 10 or 40? It's just some kind of agglomeration of, do they do what they say they're.
Speaking of audits, what's your favorite war story from fund audits or a closing gone sideways?
I've been pretty lucky. I haven't had too many horror stories. I did meet some people early on that their form of innovation and venture, which I don't personally think is a great path to go down, but it was doing lots of small checks in lots of companies. And then later on, they decided to take one big check from one big investor who now wanted them to be audited. So they had, over the course of several vehicles, 300 investments that they then had to bring through an audit process. And in many of them, they weren't major investors. They didn't have any information, and may not even have a contact at the company anymore. I talked to the people doing that work, and it was,
Yeah. So we'll probably be in that situation. How can I get ready for that? Because we're writing 25K checks, and we have 200 of them sitting out there. I have information rights for most companies, but not all. But like, how can we get ahead of that?
I think you need to be very diligent about keeping your deal documents, what you sign, having good copies of it. I think you need to have a process for reaching out to founders at the end of the year. They're updating their COIs, their certificates of incorporation. They're, getting new 409As. They've got ESOP plans. There's things that they're doing that produce documentation that you may value or be able to
Oh, interesting.
use.
I can ask them for they're probably getting a 409A on their side. I can ask them for that document.
You could. I mean, they may not give it to you. And again, 409As are done with a different purpose in mind. They're a different accounting code
Yeah, they're not
section,
really
right?
at, like, if they raised a round at 400 million, their 409A might say they're worth 25 million, right?
Right.
Yeah,
Yeah.
like a fraction
Exactly.
of their latest valuation.
Right. Because it's for different purposes and what they're doing. And you take in different liquidity
I keep
premiums.
a
And there's,
folder with everything I've ever signed and every doc. I mean, typically, once I convert in the A, I get preferred shares. And that's the end of it because I wrote a 25K check. So I know what I converted at, what the fair market value is. Typically, they'll give me the share price in every successive round if I ask, but I don't have documentation necessarily for that. It's just kind of like, yeah, you converted at $2 a share, and now it's $5 a share.
well, I wouldn't recommend going back retroactively and auditing a fund that's already been invested or is 4 or 5 years old, just because one new kind of shoe in LP comes in at the last minute and you amend docs to take their big check. And I wouldn't necessarily recommend that. But going forward, if your next fund is audited, then, you would just start fresh with that. Each fund is audited separately. And so you can start fresh with the new fund and do your processes the way, it sounds like you're going to be very good at this. So.
Yeah, I'm trying to keep good docs. I'm a CFA finance nerd like you, so.
And the key is you have to do the quarterly and annual updates, and that you need to have a process for it. And it might, in your sense, be a series of Google notifications when companies announce or pitch book. You may have to invest in a data gathering tool that helps you just be aware of when rounds post, and it might be something that's honestly scraping Delaware filings for updated certificates of incorporation, just to give you a trigger to then go ask for something.
Yeah. What do those
And then
updated certificates mean? That means a new round?
not necessarily. Just, I mean, there's lots of different parts. They're very long documents. They might be, usually, if there's some sort of board resolution or consent, there'll be something done to change voting requirements or thresholds, just like you would amend your LPA, or a business might amend their bylaws or their operating agreement. Companies will update their certificate of incorporation, which is a filing they have most often with Delaware for the Delaware C Corps. And there's lots of different things in there. One part of it might be the issuance of new stock. And so did they authorize and issue new class of shares? How many of them? What was the original issue price? And so from that, you can get some clues, and then I would definitely verify. There are a lot of breadcrumbs in COI.
So you've worked with Techstars. How do you view accelerators now in 2025?
I think Techstars has changed quite a bit idiosyncratically. I think it's a much different company and different thing than when I did it back in 2016. I think accelerators have gotten commodified, and so if your only offer is commodified value, you better have a really awesome demo day with a great network that writes checks. And I think founders should really key in on that part of it, because that's kind of the, why are you doing this? And it's so that you can attract investors after the accelerator. I think there's still a lot of what I call WASTA, which is an old, it's the implied market forces behind YC. Like, I think there's still people that value YC as an accelerator. I do hear a lot of investors complain that it's expensive, but that's because there's a lot of demand. And so it's a little bit of a market issue, not necessarily YC's programming. I think for most founders, and I think this is broadly general for all people, AI has changed the game in a way that there's no necessary, the expectation that you teach yourself and that you come a lot more prepared, I think, is going up. So with these tools that give people the opportunity to do that, be autodidactic, create more vibe code, do all these things, the accelerators are going to lose value because that was what they did. And so they're going to potentially have a selection bias issue where the best founders wouldn't do it because it's a dilutive form of capital they don't need. I don't know. We'll see.
Yeah, I think it's great for first-time founders. I'm a big fan of YC because I have a YC focus fund on my
Yeah.
second YC focus fund. Actually, I've had
Do
a
you think it's
lot of.
expensive?
Oh yeah, it's super expensive, but I've also had some of my best markups there too. Yeah,
There's a
you
lot
get
of
in at a
demand
20
for it.
cap, but at the Series B, they're at 4 to 800 caps or even $1 billion caps.
I
You
mean,
know,
there's a lot of still pull for YC. I think they kind of ran away with it. I don't know that there's necessarily a competitor.
yeah, no, they're in a league of their own now. I mean, TechStars is definitely was nipping at their heels for a while, but I feel like I talk to TechStars founders now, and they're just having a lot more trouble raising than YC founders.
Yeah. I think the venture studios are going to be the really interesting piece.
Yeah, they tend to
Right?
have good returns. Yeah,
They have good returns because they take a large share of the cap table early on. So, Fractal had that big issue a couple years ago where people just kind of got turned off to any company that was a Fractal company because their cap tables, and so I think venture studios is still in the early innings of figuring out what that's going to be like too. But I know a lot of really great venture studios.
yeah, they're great. I'm a big fan. So if you weren't doing this, what would you be doing?
Kind of jokingly say I think I would, if I wasn't doing this specific job, I do enjoy talking to GPs and building out venture funds. I like the idea of it. So I think there's a natural evolution one day to helping people build out their platforms of venture fund managers, not as a placement agent, but more of just helping people think through what is a good venture strategy. And I do like that. But if it was just not venture related at all, I joke. I have lots of startup ideas. One would be selling drones to farmers and ranchers all throughout the Mountain West. So you get to travel around, see beautiful landscape, but they are going to need aerial drones for surveillance,
Mm,
predators, counting their sheep, forest fires. You could have like a tethered drone with Starlink if you have a heart attack out there while you're cutting corn or whatever it is. Like there's lots of reasons why that technology could really benefit individuals out there, and we're going to need to sell a lot of drones. And so I think that could be really interesting. And then I'd also probably start a social club around DIY tasks for millennials, so we could all learn how to fix things and just that was the original idea. It was a veterans focused one. I was going to get a bunch of vets together and we were going to build a club and teach each other how to do home improvement tasks.
yeah, that's awesome. Well, it's been great. Time flew by. I learned a lot. Where can GPs like me find you online?
Yeah, I'm Dave at signalfundservices.com for email. Please reach out. I'm on LinkedIn. We have got a website. I'm doing some videos on LinkedIn and they're up on YouTube as well. Signal Fund Services. We're trying to write the playbook for how you should build an emerging fund. And maybe we can answer a bunch of questions and speed you up to the answers and avoid a few landmines.
Well, thanks so much, Dave.
Awesome. Thank you so much for having me. I've enjoyed this conversation.
Likewise.